core company is what we think is a company that can grow its intrinsic value almost in any certain macroeconomic circumstances, whereas an opportunistic company is a company that's growth depends more on cyclical factors rather than secular factors. And for those companies, we need to be buying them a huge discount to what we think their intrinsic value is. We also like to have only about 20% downside to what we think is our worst case scenario, so just sort of protecting the clients from volatility. Steadyhand, we're looking for three key things: people, business, and price. We want great businesses run by great people at a great price. You know, a great example of that would be Asia Pacific breweries. It's got the Heineken brand, the Tiger brand, and Guinness, and a whole bunch of other brands diversified all over Thailand, Cambodia, Indonesia, and great growing markets. Beer's an easy to understand business. You know, all those demographies are growing. And we think it's been around for 100 years. We think it's going to be around for another 100 years. That's a great example of a good steady hand type of business. Oracle would be a great example. It's a classic steady hand type of business in that Oracle's databases are embedded in almost every company around the world. And if you go to a CIO and say, I want to rip out your Oracle database, it's going to be very, very upset because, you know, these got millions of database records in there that would be very difficult to remove and start up fresh. So if you look at the Oracle business model and see how they're embedded and entrenched there are in these corporations, and then with Oracle's history of acquiring different software companies and leveraging that installed base, they have a phenomenal opportunity to grow their sales and earnings and free cash flow, which are all the things that the steady hand investor should care about. Now, the reason it's an opportunistic company is because technology changes very rapidly, and at CGOV one of our criteria is to look out 10 years, and for a technology company such as Oracle it's very difficult to look beyond the 10 years because some kid in a garage could be inventing the next super premium database that we may not know. So it's difficult to say it's a core company, but as Oracle's about as core an opportunistic company you could get. There's no magic science to that. Traditionally it's been about 2/3 core companies and 1/3 opportunistic. Mostly the core companies are more stable, but we take what the market gives us, and if the market's mispricing opportunistic companies, we'll take those at a huge discount, or if the market's mispricing great companies where we can get huge returns, we'll take those. So it's really, that's where the magic and the art comes in portfolio management. There's no real science to it. One of the things that we here were most surprised about was the, investors relentlessly putting money into bond funds. The money that went into bond funds was almost like the internet bubble in 2000, and it's been a 30-year trend, and maybe we're too early to call the end of that trend, but when steady hand and equity investors can get 2.5% on yield on their fund as opposed to 2% on a 10-year bond, we think they're better served getting 2.5% on a growing dividend basis as opposed to a fixed 2% that's going to be eroded by inflation. In 2011, our dividends grew about 11% for the Steady Hand Equity Fund, and we anticipate that happening again in 2012. For the Steady Hand, we're not trying to find the highest dividend, the 5% dividend that may never change. We're trying to get those companies that are growing and can increase their dividends at a steady rate over time. For an example, Suncor's indicated that they'll grow their dividend in line with their production, which is supposed to be 8 to 10% over the next decade. And we take that over a stagnant bond any day.